Now is not a good time to run a business in Russia. Behind the facade of glitz and money, foreign direct investment has fallen by 30% in the first half of this year. The public are also hit hard. Personal loans are now only available at interest rates of 15% and more.
As financing becomes more and more expensive, the crisis is actually hitting pretty much everybody. And the growth forecast for next year is going down by 0.5 percentage point every week.
One of the hardest hit sectors is real estate. The number of new mortgages issued has dropped by 30% since June. As demand cools, prices will fall by 15 to 20% by the end of 2008. Yet amidst the turmoil, there are opportunities. The BV Development Private Equity Fund has allocated $50 million to invest in property on the basis of an undervalued market.
There is a lot of very good properties here, projects just on the beginning of the construction. If you are still able to just walk in with equity, and then you will get the best tenants, very good conditions on the leases, and then you're moving into the next upside in the right time.
Similarly, despite a stagnant auto sector, General Motors, the largest foreign car maker in Russia, is confident its new plant in St. Petersburg will prove profitable.
We certainly are, let's say, trying to plan a little bit more conservatively for 2009, but when you build a plant, you really look at an 8 to 10 year time horizon and usually several product, what we call life cycles within vehicles. So we're in Russia for the long term.
The government, however, has focused on short-term firefighting, spending over $17 billion supporting the ruble, and has pledged more than $200 billion to banks and companies. There are over 1,000 banks in Russia, and analysts believe some of these may not survive the crisis. State-owned banks, however, have no such worries.
The Russian government provided substantial support to largest state-owned banks and the largest banks in the system. We recently received the first installment of subordinated debt. We received 100 billion rubles of subordinated debt. We expect another installment in a few weeks of the same amount. This money obviously will go straight to the real economy. We will use it to lend to corporates.
Russia's stock markets have also been harder hit than most in the West, plunging 60% since May, largely due to fears of government interference in business and Russia's military conflict with Georgia in August, which drove $7 billion out of the country in just 2 days.
The good news for the investors is that unlike August, when Russian government said, we are not afraid of a new Cold War, we are not afraid of isolation. If needed, we don't need to join WTO. We don't need foreign investment if foreign investors are unfriendly. And that sentiment is gone. Russia doesn't any longer believe that Russia is a safe haven. The Russian government says we're open for cooperation with foreign investors.
The biggest immediate challenge for Russia is the lower international prices of crude oil, which have more than halved since peaking at $147 a barrel. With much of its budget dependent on oil revenues, this is putting pressure on the government's plans to spend on infrastructure and social programs. The Kremlin will be forced to use its stabilization fund created from oil profits. The world's biggest energy exporter, Russia still earns $700 million a day from oil, compared with $100 million a decade ago. Oil has fueled an 8-year economic boom in Russia, and the Kremlin is sitting on the world's third largest foreign exchange reserves.
Russia has, with 140 million people, they have everything that the other 6 billion people in the world want. So I think that, yes, Russia is going to and is feeling the effects of this, but they will be in a position to come out of it sooner than any of the other countries.
As the economic chill sets in, the International Monetary Fund predicts Russia's economy will grow by 6% in 2009, down from 8% last year. But if oil prices drop any further, growth could fall to just 4% next year.